So in our next session, we're going to continue the theme a little bit, and we have three very seasoned private equity investors who are going to share with us their take on the current state of private equity markets in Asia, the trends and opportunities in individual markets, and also investment in technology in Asia. Our moderator for this panel is Mr. Samson Wong, Chief Investment Officer, Private Markets at Hong Kong Monetary Authority. He's going to lead the discussion, joined by Nisa Leung, Managing Partner, Qiming Venture Partners, Jean-Eric Salata, Chairman of EQT Asia, EQT Group, and ZHANG Lei, Founder and Chairman of Hillhouse. Our stage is reset, so we can welcome our moderator and panelists to the stage, please.
Good morning, everyone. Today we're going to have I hope, pretty interesting discussions. Yesterday in the summit, we have a panel focusing on the trends of global private equity. And just now we have a panel talking about alternative assets. So now for this particular panel, we're going to zoom in more specifically on private equity in Asia. May I remind the audience that you can scan your QR code, and then towards the end, I'm going to ask our panelists the questions that you're going to raise. So without further ado, let's begin. So Sean and Lei, in the recent years, we have witnessed a confluence of factors: higher rates, escalating geopolitical tensions, and a slow exit environment for private equity, including Asia. All these factors are leading to some sort of risk aversions among investors, limited partners specifically. And notably in Asia, private equity fundraising has slowed down a lot from the peak that we have seen in 2021. So can you share with us what you're hearing from your large institutional investors around the world, how they think about asset allocation? Are they still interested in Asia? And are they approaching Asia differently? So maybe I'll start with you, Sean, first.
Well, thank you, Samson. Thank you to HKMA for hosting this event. It's great to be here. I think the question I often hear from investors is, we've been making so much money in our private equity programs in the United States. Why even bother come to Asia? And I think that, if you look at the last 10, 15 years in private equity globally, returns, you could argue, have predominantly been driven by two things, largely been driven by two things. One is declining rates, which have essentially resulted in expanding market multiples. And the S&P 500 has been a great place to invest, and that kind of market beta has driven and lifted all boats, including private equity. The second key driver of returns during the last 10, 15 years was very low-cost leverage, almost zero interest rates for a period of time. And that enabled people in developed markets to use cheap debt, expanding multiples, rising stock market. And of course, there was also a lot of good things happening in the companies. But the effect of that was to, I think, create a kind of very high levels of returns in developed markets, and particularly the US. In Asia, and so where are we today? And today you have valuation levels in the US are at the 97th percentile in the last 100 years, if you look at PE multiples, which implies that going forward, public market returns are going to be something like 3% per annum. So the idea that you can continue to make money from just pure market beta and multiples expansion is going to be harder to come by in the developed markets. And what we see in Asia, and what some investors are looking for in Asia, is what we call true alpha, the ability to generate returns regardless of what's happening in the public markets. And there's four things that we tell our investors are really interesting about Asia when it comes to generating real alpha, independent of market beta. Number one, we have much higher growth in this region. So if you look at the kinds of companies that all of us are investing in here on this panel, say healthcare, for example, look at healthcare spend in India as a percentage of GDP, it's 3%. In the United States, it's 17%. There's a huge gap, and there's a tremendous amount of growth still in, say, healthcare in India and many other sectors, software and others. So growth is really one key driver of returns in our region. Number two, we have a lot more undermanaged assets in Asia as a result of the fact that there's still a lot of inefficiency in the system. You look at a market like Japan, which is one of the markets that we are very active in. There you have over 1,000 companies trading below book value right now. And the government there is quite serious about improving shareholder governance and improving the efficiency of these businesses. So, and we can talk more about Japan later, perhaps. Number 3 is that there's also a kind of uncorrelated pools of liquidity in our region, which enables investors to get capital back when other markets are shut. Last year actually was a very big exit year for us out of our India program at a time when the US market was not delivering a lot of distributions because the markets there were shut. And then lastly, I would say that our region is still underpenetrated in terms of private assets. If you look at total global private equity allocations out of institutional investors, about 6% of global allocations come to Asia. 94% are going to the developed markets. Yet we represent half of the world's GDP. We represent 60% of global GDP growth in this part of the world, but we're only getting 6% of the capital. So even though our markets are competitive, there's still, I think, an imbalance in the region. And this is, I think, what's attracting investors to the region, this idea that you can generate this excess return in a world where you're going to really have to look for growth to generate returns rather than just rising stock markets.
Thanks, Sean. Very comprehensive. Lei?
First of all, thank HKMA for organizing this very incredible event. I'm very glad to be here. Like to me also share a little bit, I agree with Jean, a lot of what he said about Asia being a under-penetrating market with uncorrelated returns. But a couple more things I wanted to highlight. One, if you invest in real private equity, this is the market you really stay close to the real economy. This is not about leverage. This market, we look at our returns historically, the leverage in Asia market is multiple lower than the rest that of the US and Europe. So you see rarely the opportunities for Asia private equity just being leveraged and cost cutting and get financial engineering. This is not a financial engineering market. This is a real economy market. That's one. 2, I think you are seeing a lot more entrepreneurship in this market. That you do see mature market when you have great management, entrepreneurship, and you could cut both ways. You know, you get the entrepreneurial drive, you get companies to really have a lot more innovation in the marketplace. At the same time, you could also leave a lot of room for private equity to do mature management and helping entrepreneurs in the right place. So I think this gives you the opportunity for investors to access totally uncorrelated return, I would argue, with much lower risk, both out of leverage, and also out of the multiple expansion. You don't have that high multiple expansion risk you see in other marketplace.
Thanks, Lee. So it sounds like growth and innovations are some common themes that I've heard. So Nisa, may I turn to you? So Qiming focuses very much on early stage venture capital. And valuation of startup has adjusted quite substantially around the world, not just in Asia. Besides valuation, cash distribution to limited partner is another top of the mind issues I assume for your investors as well. Besides these challenges that we have seen, what opportunities are you seeing broadly in venture capital? And how do you keep your investor happy in an environment like this?
Thanks, Samson, again, and thanks, Eddie, for this setting up this conference and inviting me. I think, the last, having done VC investing in China and Asia for 20 years, it's definitely a down cycle. I think the US dollar investment in China is down 85%, and renminbi investment is down 70%. But I totally agree with Lei and Jean about entrepreneurship in China and Asia. I mean, 65% of our first money in has always been angel round and Series A round. And I would say that, we've invested in 550 companies. What's really interesting is that the companies, it's so entrepreneurial. When we first started 20 years ago, and I focus on healthcare, it's all black and white ultrasound machines and patient monitoring system. Now, when you go to any of the medical conferences, anything that you can see developed in the Western world is available and developed in China and for the world. So, about 40% of our healthcare companies actually have offices and headquarters in US already. So it's really amazing what the entrepreneurs have done. But back in 2021, I think, when it comes to cash distribution and how to weather the current state, back in 21, I told the team not to invest in any pre-IPO deals just because the market for the whole pre-IPO has been so crazy. So we stayed away from that. We continue with our core to invest in angel and Series A round. But because we went through a few cycles where A-share market actually stopped allowing IPO, back in 2013 to 2016, I still remember there was one of our companies filed IPO back in 2012, and they waited for 3 years for IPO. So as soon as the IPO window opened, we're like, okay, let's get the companies out for IPO. So we've had 42 IPOs since COVID, and 30 of them are in healthcare. So I think we're very fortunate to see that Hong Kong Exchange introduced the 18A and 18C. This really allows a lot of the Chinese and Asian entrepreneurs to be able to raise additional funding to further the development and R&D as well as global expansion. So as a result of these IPOs, we're able to have record number of amount of DPI for our investors in the last couple of years and probably in the next couple of years as well. But in the meantime, because the valuation has decreased so much and because the funding has decreased so much, it's actually a really good time to invest in startups. So, we see that the valuation on average for Series A has dropped probably about 30–40% in the market. So this allows investors like ourselves to actually be able to participate and really spend time looking at how to help these companies.
Thanks, Nisa. May I stay with you for another question, since we are on this topic? When it comes to biotech, I think there's still a lot of innovations going on. And I understand there has been a notable surge in out-licensing deals that's happening in biotech in China right now. So can you share with us what are the driving forces behind these type of transactions, and what are you seeing right now generally?
Yeah, so it's actually a very interesting trend. We would never have thought before COVID that this would happen, but in 2023, there were 96 licensing deals, Chinese assets, own developed assets, licensed by MNC or biotech companies in the US. 3 days ago, we just announced one of our portfolio companies licensed their bispecific PD-L1 to Merck for $700 million upfront, a $3.3 billion US dollars drug. So I think it's really interesting to see that MNC are starting to recognize the innovation coming out from the Chinese biotech arena. And, but, I think the companies are also deciding, do they want to, the fact that it's a little bit harder for startups to raise next round, sometimes they would be licensing out the third or the fourth best assets to MNC for global and maintain the first 2 or 3 assets. So they can use the upfront payment to continue with the clinical trial for global. So, and then, eventually the companies can go public. So I think, this is a very exciting trend. It's really exciting to see the type of innovation. We've seen a whole barrage from ADC, cell and gene therapy, bispecific, and lots of different areas that Chinese entrepreneurs have successfully developed.
Thanks, Nisa. Sean, I'll come to you. Let's switch gear to buyout. Relative to US and Europe, Asia has skewed more towards growth investment historically. And the way I see it, there are probably 2 key drivers. First, Asia's economy was more growth-oriented. We talked a little bit about that. Second, private equity buyout was probably not well understood by some of the local markets before. So as a buyout manager, what's your latest observation? And do you think Asia is maturing as a buyout market right now?
Yeah. Well, the Asian buyout market is growing. In our strategy, we view private equity essentially as a governance strategy. It's about governance. we control every company that we invest in, we will control the company. Why do we want to do that? We want to do that because of really two things. One, we want to control the value creation of how we transform the business, and we also want to control how we exit the company and the timing of the exit, and so that we can get liquidity on the investment. And I think the buyout market, which, you're correct, historically was really not very large in Asia. I started in this business in the early 90s. I see Edmund Zeh in the audience. I was at AIG Investment Corporation in like early 1990s, doing private equity in the days when there was only minority investments really available. But the market has changed, particularly I'd say in the last 10 years. And we now are seeing really quite a large buyout market developing. To give you some numbers, when we first did our first buyout in India in 2013, it was a $2 billion buyout market that year, and we did a $200 million deal. We were 10% of the market. Last year, there were $10 billion worth of buyouts. And the forecast, if you look at McKinsey and Bain estimates, is that that's going to a $50 billion buyout market by 2030. And if you look at the core buyout markets that we focus on, which would be Japan, India, and Australia, those three markets last year were about $75 billion of transactions. That number is going to be something like 165 to 180 billion by 2030. So it's going to double, and it's going to become actually quite a substantial market. And I think actually what's interesting is that being based in Hong Kong, I think this is the perfect place to cover the entire region as a buyout investor, and it's really a perfect hub. And we've been based here for now 27 years as a firm, and we have an $11 billion buyout fund. We're raising a larger fund at the moment, and it's a market where you have a lot of connectivity to what's happening around the region. So we feel like this is actually a good place to run the business from, but having local country teams covering the markets in each of the areas that we invest in. But overall, we're actually very positive about the markets, the buyout opportunity, and we think it's going to continue to scale.
Thanks, Sean. So next, I want to talk a bit about the China private equity market, because as we all know, China PE historically was half of the region's investment activities when it comes to private equity. Now, China, the headline GDP has slowed, but having said that, it's an $18 trillion economy. We all know that. So there must be some interesting opportunities in China right now. And I would like to make a comparison versus Europe. While the headline GDP there is 1% or less, but I've seen a lot of private equity firms making strong double-digit return in Europe right now. Now, so this is for Lei and Nisa. China has launched a series of additional monetary and fiscal measures, as Professor Wong has told us the proper terms to use about these new measures announced by the Chinese government. Now, given your experience investing across cycle in China, can you share with us your outlook of China from a private equity and VC perspective? And in particular, if you could just focus on the domestic market in China for now, what are some of the sectors that you're thinking that are interesting? Lei, perhaps, can you go first?
Sure. I'm not a macroeconomist, so I'm not going to focus a lot about, the macroeconomy, the sort of the economic growth. I think there's a lot of positive news that we saw, and even we hear yesterday there's many more stimulus package coming. I'm sure there's going to be multi-leg. There's going to be much more stimulus on the way. But first, I wanted to remind everyone, in the end, we are bottom-up investors. If you observe, interestingly enough, almost the best businesses are born and made in the most difficult times. And do you guys know when AWS was founded? 2003, 2004, when internet bubble burst, 2002, and at the age of 2003, 2004, Amazon's existence was called into question. And do you know iPhone moment? That's 2008, 2009, right after global financial crisis. Now you look at Japan, the so-called lost decades. Amazing company from Itori, Uniqlo, incredible company were formed. Nippon Paint, and that's formed, but grown out of that. So I really want to remind you that as such large economy with brilliant entrepreneurs, with this drive and resilience, I couldn't think about a better environment for stress testing the best entrepreneurs. And I'm sure 20 years looking back, these are gonna be greatest businesses, entrepreneurs in the making.
Thanks, Lei. Lisa, do you have anything to add?
I agree. Now, I think the best return deals that we've ever made during these difficult times. But what's really interesting is the entrepreneurship 20 years ago versus now. I think there's so many, we're generating so many engineers every year. And a lot of these engineers grow up with a lot of the new technologies around them. So we're really starting to see smart manufacturing, consumer tech that are using all types of AI, biotech, healthcare. So we're seeing a lot of really interesting new business models that we would never have imagined 5-7 years ago.
Thank you. Lei, so one of the key trends we are seeing in the recent past is that many Chinese companies are going out. And many of our speakers yesterday spoke about the China plus one macro theme that's taking place in Asia right now. Can you share with us what you are seeing from a private equity standpoint around this China plus one theme? And what does it take to be successful in this particular strategy? And what role do you think Hong Kong could play in this regard?
I think this is a massive opportunity because from China perspective, also there are a lot of those entrepreneurs, their businesses, many of them are global in nature because they're the best in what they do on global supply chain. Increasingly, I'm seeing that particularly going to Southeast Asia, ASEAN countries from the whole EV battery supply chain, energy storage to consumer goods company even earlier. So I'm seeing a lot of those entrepreneurs. By the way, the technology internet guys did that before. So when we first invested in the e-commerce companies and logistic delivery companies, and looking back, we brought the talents from Meituan and JD, and they worked on our investment in today's Shopee. And 10 years ago, when we first made the investments, today Shopee become a dominant Southeast Asian player. And then you're seeing that similarly with Grab, with the EV battery supply chain, you're seeing that many more companies repeating this game. I think the key success factors, it's about the best entrepreneurs going around and dedicate their efforts. I think Hong Kong is well positioned to take advantage of that because they need a sort of regional headquarter or global headquarter for them to build not only international capital markets and attracting capital. They can get it anywhere, but really building on a talent base and an international hub. We were talking with one FVD company in the hinterland of China. There's no way they're gonna be able to recruit the best talents who are English speaking, able to penetrate into the ASEAN countries. And now Hong Kong is the perfect place for them to build a regional headquarter and also expand overseas, bringing talents over. And increasingly, I also see they use Hong Kong even as a research hub, as there are more and more universities, life science park have a dedicated program for that. So I think there are a lot of opportunities, and we're just at the very beginning of this.
Right. Thanks, Lei. So Sean, I think some of our speakers have briefly talked about India. And India is playing an increasingly important role in Asia's private equity deal activities. And it's accounting for roughly 20% of the transaction volume today. And a few of the sectors that have been quite popular for private equity investment in India include healthcare, manufacturing, IT services, and consumer. I know EQT is quite active in India as well. Can you share with us the driving forces behind the increasing interest in India? And what should we be worried about when investing in India?
Yeah. Well, we've been on the ground in India since 1996. and investing there since then. I think the market has come a long way and has evolved into a really interesting opportunity. I mean, at a macro level, India has 1.4 billion people, half of which are under the age of 30, so 700 million people. They are essentially all looking to get an education, to get better health care, to buy their first home. So if you look at the thematic investing, which is really, we're very thematic investors and looking for long-term structural growth drivers in our investment strategies. You know, one of the key areas that we're focused on is healthcare and healthcare services. For example, we just acquired the largest fertility clinics business in India, the IVF clinic business. They have a 50% market share across the country, and it's growing. We just acquired the largest student loan business in India that's helping students get an education and go abroad to get an education. So these are really, I think, long-term structurally growing sectors of the economy. And that's kind of the domestic part of the India story. But there's also an export global part of the story, which is even more interesting to us in many ways. And it's actually a larger part of our investment strategy, which is the whole tech services industry. The tech services industry is basically a play on two things. One is the global technology spend, which is just a long-term growth trend that started with, you know, Y2K, for those of you that remember that, in 1999, you know, that all the computers are going to blow up in the January 1st, 2000. That's how the Indian tech services industry began. But then it got into the internet, and then it got into cloud and mobile and cloud migration, and now it's AI that's driving tech spend in India. So it's a play on tech spend, and it's also a play on talent and the amount. You know, there's something like 3 or 4 million computer scientists in India, English-speaking, highly trained, and they have a deep pool of talent that continues to come through the school system there. So the matching of the talent pool with the global spend is a very interesting long-term thematic that India's been able to capitalize on. And that industry now is something like a $300 or $400 billion industry, and it continues to track well. And there's a lot of buyout opportunities in tech services. I think if you talk about what could go wrong and you know, what some of the issues are. I think one of the key drivers of India's development has actually been its positive business environment driven by the positive political environment under Modi. And Mr. Modi, I think, has been able to create an environment that's business friendly, that is fairly consistent in terms of its policy towards the business sector. And I think as long as that continues, we'll see things continuing as they are today. But if that were to change, I think that would be a risk. One last comment I'll make about India is that India used to be a tough market to exit from, to get liquidity from. That's also changed. And the reason it's changed is because the stock market has become so deep. It's a $5 trillion stock market, actually. That's a pretty large market cap for the stock market. It's like 4th or 5th in the world, slightly, I think, behind Hong Kong. But it's a deep market, and it's basically a market that is now driven by domestic savings pools, whereas previously it was largely driven by foreign investment income. There's something like $40 billion a year of new inflows going from the middle-class savers who are essentially investing their savings into the stock market. That's creating a very nice investment and exit environment for private equity investors.
Thanks, Sean. Leah, I actually want to ask you one more question because I checked the questions from the audience. So yesterday, I think we talked about private credit again. So Mark Rowan and Howard Marks talked a little bit about it. And the key takeaway I got is there's no private or public credit. There's just credit. Now, I just want to ask you a quick question. The traditional banks in Asia are still the dominant credit providers in this region. And what is your own outlook of Asia credit or private credit?
Yes, I think banks still gonna play a critical role in Asia. Even in private credit or public credit, they're still gonna be a facilitator, particularly a lot of that is about business relationships. We think about credit just another way to express a business relationship. In that regard, banks are well entrenched in all those business relationships. But what I see banks are, they're very, very good at sort of financing solutions related to trade or transactions. But for banks to make a multi-year bet on the credit quality of any counterparty, I think it's very hard. I think that's actually the skill sets what people like John and us and Nisa, we would make. Say, hey, this is a multi-year bet. We think they're going to go well or not. I think increasingly you're seeing banks, we We have a private credit strategy now doing really well. The first half we already developed quite large amount of capital. You're seeing that banks a lot of times actually are partners with us because they are facilitators in the transactions, continue to provide working capital. They actually get even more confidence on the company that we selected to be our private credit portfolio companies because it's another verification, another portfolio management, constant portfolio management as us, as the investor into their businesses. So, and I think anything that had to do with a multi-year bet, with a longer duration, with betting on business nature beyond just owned by the real assets, that's actually investors have an upper hand, but investors would love to work with the banks to for that what I call the total capital solution to the real economy.
All right, thanks, Lee. So I think we have time for one question from the audience. We are seeing rising opportunities in the Southeast Asian market for some time, but illiquidity and fragmentation are still challenging. Can you share with us your view about the opportunities in Southeast Asia? Well, Sean, you want to take about it?
Quick answer. We agree Southeast Asia is super interesting. It's an area of focus for us. We actually just acquired the largest online classified real estate business that was listed in Singapore called Property Guru. It covers Malaysia, Thailand, and Singapore and Vietnam. And it's an online marketplace. It was about $1 billion transaction. We love marketplaces. We think they have really interesting kind of almost winner-take-all economics. And I think there's going to be more activity there, but I agree with the point that it is a more fragmented market, and it's harder to find scale opportunities there given just the geography. It's probably slightly earlier in maturity as far as controlled buyouts are, but I think there's a lot of interesting growth and venture opportunities in Southeast Asia that I'm sure my colleagues invest in more than we do.
Okay, great. So I think that's 30 minutes. And thank you, Nisa, Sean, and Lei for the very interesting insight and discussions. And may we give them a round of applause. Thank you.